Good day, fellow investors. These quarters pass by fast. The new Guide to Markets by JPM is out, and I know you really enjoy these overviews of the market, of the economy, and also global issues. If you want to find it and download the slides, just type in Guide to the Markets in search JPM, and you will be able to download the quarterly edition. The topics: we have the markets, the economy, bonds, global issues, also alternatives and investing principles to see how things are going. We'll go over the selected slides, but the topic of today is you will see how the past is highly volatile, insane, crazy, but the future, when it comes to predictions, is always linear. If you enjoy this, don't forget to smash that like button. So we start with the market, and 2022 was a crash year, 20% down. Even if I said that it's an unlikely crash for 2022 because interest rates can't be raised that much, now the market has already rebounded a little bit, so we are out of that crash from the January 3, 2022 peak. However, what I am looking at, and it scares me a little bit, is this. From the bottom in 2008, 2009, stocks went nothing but up. If you erase the volatility here, it has been insane, and these have been the best 14 years in the history of any stock market, probably. So always keep that in mind when it comes to investing. Valuations, if we look at what Wall Street presents, they are saying, look, the valuations now are average for the 25-year average. Wall Street is always exuberant and they will always show you the better picture. But if we look at historical price-earnings ratios, and if we take the last 25 years, you can see that the average for the last 120 years was around 15. So this is the 15 line. And over the last 25 years, only once has the P ratio, the real P ratio, been below 15. So Wall Street is always about exuberance, and it is always about the future because they show the forward price-earnings ratio because it is lower. So lower P ratio, higher expected return, and they can say, okay, look, the forward P ratio is 16, but if I go back to the real current P ratio, it is 20.59. So it isn't as good as Wall Street wants to present it, but Wall Street, as I said, is always exuberant, and this is the reason for the better presentation. These are 2021 earnings. Then we have had the earnings recession in 2022, but then Wall Street already looks at 2023 and 2024, and earnings, according to Wall Street, will grow at 10% per year. Never again we will see an earnings recession like it has been the case every few years here in history. So the expectations are extremely positive, but always keep in mind analysts overestimate earnings year by year. That is their job, to be overly positive. So be very careful not to fall into that trap because earnings do usually follow a long-term earnings trend in line with the economy. And if I delete the expectations, you can see earnings growing, and this was because of corporate taxes going down thanks to Trump, and this jump here was because of all the stimulus. And now Wall Street expects that earnings are simply going to continue to grow, but my question is, what if earnings just continue to grow in line with the pre-pandemic trend, and let's say they settle at 175 S&P 500 points in 25, not at 250, how Wall Street is expecting them based on linear growth projections. And if you look at the market, you can see that there are many surprises around the corner, and that it is not unusual to see the market go down 20%, 28, 49, 30, 20, 20, 34, especially in a high recession risk scenario. And you can see that the market usually bottoms mid or only end recession. You can pause the video here and look a little bit at when the market bottoms, the green line versus unemployment and the lasting of a recession. Very interesting. When it comes to the economy and the recession, let's first look at the most insane chart for me in this JPM presentation, because this is pure insanity in my opinion. What's insane? It is insane that the government can spend 17% more than what it makes and then expect linear future GDP growth 1.7, 1.6% stable for the next 10 years, even if this is what the CBO expects. But Ray Dalio has said that at best it will be 1% and 0% for Europe. Plus, their expectations is that with the government borrowing 5% of its budget forever and increasing those borrowings, government debt will not go high. I don't know how they do this mathematics, but this is totally insane for me, and that's why when I see these linear assumptions, I know there is something wrong. Plus, if we look at the economy, things still look good, but we still have excess savings remaining of almost 1 trillion in the US, similarly in Europe, and that is from the time you were sitting on your couch and getting money from the government. However, these excess savings have created the current inflationary situation, but let's again look at Wall Street projections. If we look at inflation now and compare it to projections, everyone is just saying inflation will be where it was before the current pandemic and will be around 2-3%. Things will return to normality. And if we look at what's baked in, what's projected by the Federal Reserve and the market expectation, everyone expects interest rates to go down over time as inflation subdues and things normalize, and then again to have interest rates lower, and then we enjoy life as we have been enjoying it over the last 15 years where there was a flood of money. If we look at the balance sheet, again, financial crisis, European US budget crisis, pandemic, and then the projections for the future are completely linear. Everything will be good, never more will see a shock. And that's again something that, yes, it's their job, it's the job of analysts, but will it happen? I have no idea, because I have learned that in my life and wherever I have to expect shocks, and shocks. And given what we have been enjoying in the last 10 years, I expect many more shocks in the future, because this is again something insane. With inflation at high rates, if we look at the real yields of treasuries, it is still extremely negative. That is because people are expecting the lower rates in the future, and therefore now they are willing to take these negative rates. However, this might happen, this might not happen. On monetary policies, with tightening expected ahead, again, everything linear, all these interest rates will revert to the mean, will be linear, already starting to be linear mid-2020, and we will enjoy life as we had been enjoying it before the recent inflationary crisis. But if we look at inflation, it is still there. It's still 7-8%. In Europe, it is even higher than 10%, 12.6% in Italy. So why would this just simply go away? Will it just go away because they are projecting it to go away? Who knows? But for inflation to go away, we have to start spending less, and you'll see later a game changer when it comes to this, which means recession if we spend less, or prices simply should not move higher. But there is a game changer here. Let me show you. This is the game changer. So over this decade, 1.5 billion people will enter the middle class. If that happens, 1.5 billion is twice what lives in Europe, for example, and Europe, US, the developed world combined is equal to this. And they are going to increase the demand for all the things as we compete on a global level, for all the things we are buying too. So I would not be surprised, and Ray Dalio said 5% stable inflation forward, not 2% as everyone is expecting, because these guys are coming in. Plus, if we have higher inflation, higher interest rates to tame inflation, meaning a recession, or more money printing to prevent a recession, which means more inflation, then also something that gets very tricky is the huge debt pile that we, as getting older population, bad demographics, compete with emerging markets that have 5 times the populations that we have in this, let's say, developed world. And then when it comes to international markets, just a digression here, interesting slide, this index went nowhere over 7-8 years, so it might be an interesting one to look for opportunities, something that I'll also check in the research process. Commodities are still high, but let's say on an average level historically. So if a recession comes, those will go low. If not, those will go higher. Now, the biggest change here, what did they do to me? This used to be 20 years and the average return for investors was about 3%, but then they said, why demoralize people? Let's show that the average investor can do much better. But in this period, the S&P 500 did 16% as interest rates went down, money was printed, and stocks had nothing but up to go. The average investor, of course, did worse because of the 60-40 allocation, but also because of panicking, selling at the wrong moment in time, and that's what Wall Street does, and Wall Street doesn't care. They will get at least 1% of your money, likely much more. So when it comes to the prediction, the past was crazy, and now we should expect everything great for the next decade. Low interest rates, low inflation, and nothing will ever change. I would bet there will be many new shocks. What kind of shocks? I wish I knew, but we can expect higher inflation than what they are expecting because their projections are always wrong. And this is a great overview of what the market is pricing in. We'll discuss real estate soon. Real estate prices haven't gone down because the market is still expecting lower rates, more money printing, and therefore still holding those prices. But that's not efficient. So the market is not efficient. Everyone is expecting great things, higher earnings, more money, everything positive ahead. That's still priced in, and that's why we still haven't seen a crash. What will happen? We cannot know the future, but we have to be very careful with exuberant projections with Wall Street's job. Thanks for watching. Don't forget to smash that like button. I'll see you in the next video.